Hey, what's up? Gerard here, back to you with another tutorial video on taxation. On this video, I'm going to be talking about taxability of PEZA registered entities. PEZA is an attached government agency to Department of Trade and Industry, tasked to promote investment, extend assistance, register, grant incentives to and facilitate the business operations of investors in export-oriented manufacturing and service facilities inside selected areas throughout the country proclaimed by the President of the Philippines as PEZA Special Economic Zone. Now, one of the highlighted fiscal incentives is tax exemptions in terms of national and local taxes, the basis of which is under Section 24 of Republic Act 7916, otherwise known as Special Economic Zone Act of 1995. Under Section 24 of RA 7916, the tax rate that would be in effect is 5% of gross income earned within the ecozone. These shall be paid and remitted as follows. 3% would be to the national government and 2% to the treasurer's office of the municipality or city where the enterprise is located. Now, take note of the phrase 5% of gross income. Now, the question is, how is this interpreted? So, under Revenue Regulations 11-2005, the term gross income shall refer to gross sales or gross revenue derived from business activities within the ecozone, net of sales discounts, sales return and allowances, and minus cost of sales or direct cost, but before any deduction is made for administrative, marketing, selling, and/or operating expense or incidental losses during a given taxable period. The revenue regulation also listed the cost allowed as deduction in computing gross income for specific enterprises. For ecozone export enterprises, free trade enterprises, and domestic market enterprises, here's the list of direct costs that are allowed deductions from gross income. For ecozone developer or operator, facilities, utilities, and tourism enterprises, here are the allowed deductions. So let's have a sample problem. So a company is a PEZA registered entity engaged in manufacturing products primarily for export. The following data are excerpts from the accounting records of the company in 2020. Net sales of 50 million, cost of sales of 20 million, research and development expense of 10 million, selling, marketing, general and administrative expense of 6.8 million. So the required is compute the tax liability of the company for 2020. So from the net sales of 50 million, we will be subtracting the cost allowed as deduction from the list of direct costs listed in Revenue Regulations 11-2005. From the amount given, only the cost of sales shall be allowed as a deduction. Our assumption on this is that the composition of the 20 million cost of sales are amounts allowed in the said revenue regulation, such as raw materials used, direct salaries of laborers and supervisors, supplies and fuel used, and etc. The gross income will be 30 million. Then multiplied to 5%, this shall be apportioned as 900,000, representing 3% to the national government, then 600,000 or 2% to the local government where the enterprise is located. PEZA registered entities may also enjoy income tax holidays, but I'll be discussing that particular tax incentive in my video on DOI registered entities. For more information on PEZA registered entities, you can check out this website, peza.gov.ph. I will link it in the description below. And that's it. So if you found this video very helpful, please give it a thumbs up and make sure to subscribe for upcoming videos like taxability of DOI registered entities. So thanks for watching, and I'll talk to you in the next one.